Hello and welcome back to the Note. It's getting harder than ever to deny that the US labour market is improving. Many problems though there remain with the way those figures are compiled. What we're showing you here is the 3-month average of increases in non-farm payrolls. And you can see that in the last 3 months we've had the best job growth since 1997 at the height of the Clinton boom. Plainly something is going right. This month's figures also showed a slight improvement in the participation rate and in average earnings. So although those both show that there is a fundamental weakness still in the labour market, those are also improving. Now, the most important impact that has on the market is in the effect it has on expectations for the Federal Reserve. We know they're data dependent, we know they're very interested in raising rates later this year. This shows itself most in the yields available on short-term bonds, and certainly so far this year we have seen very impressive volatility there. Earlier this year, as people got more nervous, thought that it was likely that the Fed would defer, you saw the biggest fall in 2-year bond yields since 2010. This week we have had the biggest rise in 2-year bond yields since 2011. Very big swings driven by great uncertainty over what the Fed's decision is going to be. Beyond that, the oil market has continued to show signs of stability this week. Brent crude is up. It is comfortably up from where it was 3 weeks ago. There is at least some sense that it is no longer in free fall. As for stock markets, the S&P has rebounded, although it's still not up for the year. In Europe, the critical point is that even though there is very ugly brinkmanship going on between Greece and the Eurozone over renegotiating its debt, it hasn't really affected markets. Bond yields remain very low across Europe, and the stock market is up for the year and up since the Greek election results came out. The critical question now concerns foreign exchange. The dollar remains very strong. Emerging market currencies in particular continue to weaken. That could be part of a healthy rebalancing of global growth, in which the US helps pull the rest of the world through, and a strong dollar makes it easier for the rest of the world to sell to the US. There plainly also has to be a risk of some kind of a foreign exchange crisis. We've had plenty of them in the past. The risk is of some kind of a dislocation. For the weeks that come, the focus will be on earnings, which we're getting both from Europe and the US at the moment, but also on what is the Fed going to do and what impact is it having on foreign exchange markets.